presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for February the 28th, 2023. I'm Mo Ansari, President of Compak Asset Management and host Market Wrap. Let's talk about a little bit about the Fed, the market, the economy, technical indicators, and a look at the week ahead. So we will do a little bit of all of that. Let's start with the Fed, which is really who is really driving the market and the economy right now. A month ago, I talked about, at the beginning of this month, I talked a little bit about how we had gone up a lot, hit 4,200. We'll take a look at the charts, and I said we've got to do some backing and filling. The expectation was that the Fed was going to stop raising interest rates and cut interest rates in the second half of this year. What I said was, I don't think so. I think the Fed will continue to raise rates, and they will keep rates higher until unemployment starts to go up. And that has not happened. After the Fed meeting, we got the data from the labor market showing that 517,000 jobs are created in January. One of the biggest numbers there. Inflation down from 6.5 to 6.4, the CPI, but not slowing down the decline, and that got people worried. Then we got the PCE, the Personal Consumption Expenditures Index. I know that's a mouthful. It's what the Fed looks at. It's inflation really at the wholesale level. It was slightly higher than what was previously expected. And that all combined, put together, oh, economy is not slowing down. The Fed is going to raise rates. It's going to kill the economy. So everybody went running from the expectation of Fed stopping rates and cutting rates to killing the economy and raising rates too much. Again, I think we've gone too far on the other side. Month-over-month inflation, again, PCE, that's the big number that everybody looks at. And it's, survey said 0.5, we came in at 0.6, slightly higher than expected, but still a lot lower than where we were last year. And again, we were coming down nicely, went up a little, down a little, up quite a bit. We get 1 monthly numbers. I don't think 1 month's numbers do not make a trend. I still think inflation will continue to go lower. Oil prices are going lower. The Fed has front-loaded interest rate increases. A lot of them still have not hit the economy yet. We are getting data showing home prices are starting to weaken. We're starting to see some other data that shows industrial production is weakening, but we're not seeing demand go down yet, and that is the problem. Everybody's employed, there's a lot of jobs out there, and people are still willing to spend. Even if they don't have money, they're putting it on the credit card, but that will only last for so long. Target rate now, how is the Fed? They're going to raise rates 25 basis points on March 22nd. Again, another 25 in May, but are they going to change the dot plot? Right now, the expectation is the terminal rate is going to be somewhere around 5.25. The market implied rate now is saying that it could go to 5.4 to 5.5. That means the Fed on March will come out and say, well, our previous terminal rate, that was the rate we are going to stop raising interest rates. It's not 5.5. It's not 5.25, maybe 5.5 and 5.75. If the Fed comes and does that, market will basically not take that kindly. On the other hand, if the Fed says, no, we're still data dependent, we're still looking at the inflation rate, we think it will come down, and we've done enough, I think all of that combined could surprise the market, and everybody starts running again to the outside. Oh, it's okay, the Fed is not going to kill the economy. And I think we'll continue in this until we get some clearer economy. When the economy starts to slow, how much it's going to slow. Are we going to have a deep recession, a mild recession? That is still the question. The yield curve is getting more and more negative. That's what we are seeing. That means that the short-term rates are going higher and higher, more than than we are seeing on the long end rates. That means the 2-year is going way above, and that really is showing that the economy is going to slow. Again, we are seeing consumers' personal savings rates are continuing to go up, so people are still saving. Consumer spending month and month, still healthy, and that's 2/3 of the U.S. economy. We did see some slowdown here, but we're starting to see a pickup again in spending. So spending has to slow. That only slows when people start worrying about their jobs. I've said that for the last year and a half. People still have plenty of jobs. They're still spending, even though they're starting to put a lot more money on their credit cards. When is that going to start? If we start seeing, we get unemployment data going up, we see employment data coming down. That means less people employed in the next report. We see inflation coming down. That'll surprise everybody and say, oh, things are much better now, and the market goes up. Market went through a healthy correction. That's what we've seen. Don't forget to tune in every day to my daily broadcast. You can go and type this in, Market Wrap with Mo Ansari, one word, in the iTunes store, in the Apple store. You can go to the Apple store, type this in, Market Wrap with Mo, and download the app. You'll get the daily edition of Market Wrap, a 1-hour broadcast every day. Download it to your iPhone, and you can listen to it at your convenience. Let's take a look at the technicals. Interest rates hit a high right here, 4.4. That was also low in October right here when we saw a low in the stock market. From there, interest rates came all the way down from 4.33. This was the peak, all the way down right here to touch the 200-day moving average. This is the 200-day. Interest rates came down. These are interest rates, the yield on the 10-year. Now it's starting to go back up, but I think we are right about 3.91 today is where we closed, or 3.916, or 3.2 is where we are. I think we can bounce around here. We might go up a little bit, but I don't think we go above 4.3. Market always leads the Fed. Fed will continue to raise rates. Market already has raised rates and started to bring them down. I think as the economy slows further, as we get into the summer, if we get unemployment going up, we see inflation coming down, the Fed increases will also slow down. That is my expectation. S&P hit this 4,200 right here. Here's a gap that I've talked about, which is between 4,200 and 4,218. This little space right here, that's a gap. And that is what we hit exactly right here. This was last August, and that was resistance. Also, everything moves in 5 waves. Wave 1 up, wave 2 down, wave 3 up, wave 4 down, wave 5. Once we get to 5, then we get a correction, ABC, or a 1 to 5 waves to the downside. I think even though it's showing 1, 2, 3, I think this will be an ABC correction as long as we hold the 200-day moving average, which is 39.40. As I've said on the daily broadcast, I expected the market to come down to about 39.80 to 39.40, somewhere in that range. So far, the low has been 39.43 that we made last week. Today, we closed at 39.70, just bouncing around in this area. If we can get above the 50-day, which is 39.79, that would be a good sign. If we get above 4,035, which is the 20-day, I think we're on our way up. We get above 4,200, 4,218, we fill this gap, the market is gone. Next resistance is 4,300, and then even higher, about 4,500. That's the high that we made last April, last year. So those are the resistance and support areas. On the other hand, if we break 39.40, that would not be good. It then puts us somewhere around 3,900, a little bit of support here. Then major support is right here, which is 3,800. So we'll have to wait and see how the employment data comes out this Friday. We'll have to wait and see how the inflation data comes out in the middle of March. Looking at the weekly chart, again, support 39.56. That's the 20-week moving average. Resistance 4,000, which is the 50-week, and 4,200. If we can get above that, as I've said, the party is over to the upside. That's when everybody will start running back in. And right now, people who bought, they sold out right here in October because they were scared. They bought the highs when we hit 4,200 in January because the market was leaving without them. Now they've come back down. They've lost some money. They're back out. We needed some of that. They always snatch defeat from the jaws of victory somehow. You can't stop those people. But people who are buying good quality stocks at good prices, that's what we do here at Compak. Develop a specific plan for you, where we sit down for you, look at your long-term goals, have a team that sits down, manages your money, that has over 75 years of experience in asset management. Get that kind of team to work with you to manage your money, to create wealth not chase this and chase that, up and down. That doesn't get you anywhere. It's exciting. It's fun. I know. But that's not investing. It's gambling. Go to Vegas if you want to do that. Instead, if you want to create wealth, you have to have the plan and be able to execute it over time. And that's what we can do. You can contact us here at Compak.com and we'll be more than happy to meet with you. NASDAQ, much more better picture. We are above the 200-day, which is sitting right around 11.4. We closed at 11.455 today. So we're still holding the 200-day. Better picture. And it's not showing a fifth wave top. Wave 1, 2, 3, 4 down, and then we could have the fifth wave to the upside. That is, if we can get going, fill these gaps right here, get above here, and then this gap right here. That's the August gap. If we can fill this, which is about 12.5 or so, 12.5, 12.6, that's the ways to go. But if we can get another 1,000 points higher. But if the NASDAQ starts to go up, it will pull the S&P with it. Weekly analysis, again, my dot plot. Dots are below the market. These vertical lines are the market. These dots are my indications if the market is bullish or bearish. As long as the dots are below it, market is bullish. Dots are above, market is below, that's bearish. You can see about 4 months ago, in the middle of last year, we turned positive, but then again we turned negative. This is a weekly chart, so this is, as long as the dots are below where the market is, we're in a bullish stance. And that's why I like the NASDAQ if the NASDAQ can gain some momentum. Crude oil stocks sell between 82.5 and about 70, not going anywhere, looking for the economy, how the economy works out. We have plenty of supplies. We had a very warm winter here in the United States and Europe, so we have plenty of supply. And we'll see how China reopens and how much demand goes up. So market is stuck between demand increase, maybe coming from China, and demand destruction, maybe with a recession. Gold market hit that high, 1975, and then came all the way down. Major support is right at the 200-day, which is 1782. We closed today at 1834. I think anywhere around 1780 to 1800 is an opportunity in the gold market. But if we get below 1782, I think the party is over. Upcoming, we have a webinar online on the 14th of March. You can go and register at Compak.com. Go and do that right now. A lot of people, it's a 2-hour webinar that I will do on the 14th of March. I will answer your questions live, my economic update, what I'm looking at, and what I'm looking at going forward, the technicals, the fundamentals, all of that, 2 hours on the 14th. Then I will be in Scottsdale on the 4th of April. If you want to meet with me in Scottsdale, I will be more than happy to sit down with you. Go to Compak.com, Compak.com/seminars, or just Compak.com and appointments, and you can set those up. Those are my views. Those are my thoughts. The week ahead, we are going to get the unemployment data later on this week, and then the data from the inflation data, and that's what's going to drive the market. Those are my views. Those are my thoughts for February 28th. Again, don't forget to tune in to the daily edition of Market Grab. I will be back with you in the next couple of weeks. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.